Hey everybody, it's me, Almir Krivdich, president and broker of Countryside Home Loans, and wanted to take a moment to reach out to everybody. It's been a long time since I've done one of these, so I do apologize. We've been very, very busy here, trying to come up with some new products and services that we're getting ready to release pretty soon. Some new things we're changing up, and it's very exciting. I'm very pleased that what we're going to be doing in the future. It's going to make us better partners, better advocates, better consultants. So I'm overall very, very excited. Like I said, it's going to be huge. It's going to be a game changer, and I'm excited to get this journey started also. So it's going to come out sometime in the fourth quarter of this year. So stay tuned as we get closer to release the products. We're going to keep everybody updated and stuff. So what I want to talk about today are some of the things that I keep getting asked about, and that's mostly regarding interest rates, the market, and so on. So a lot of people keep asking me about what's happening, what I think, and so on and so forth, comparing this to 2008. So I just want to try to clarify as much of it up as I possibly can. Obviously, if you have any questions, always feel free to reach out to myself, one of my associates in St. Augustine, here in Largo, down in Naples. So we're almost all over the place. Just feel free to reach out to one of us, and we'll be happy to chat with you and give you some of our knowledge and what we think is happening and so on. But anyway, so to kind of address all these things, these are kind of loaded questions, so I'll break them up a little bit. So starting first with interest rates, right? So a lot of people want to know what's happening with interest rates. A lot of people keep asking me where interest rates today and so on and so forth. So to give you a quick answer, interest rates today, as of August 1st, are actually lower than they were about a month ago. Now, a lot of people are wondering, well, how's that possible, right? Because the Federal Reserve Bank just said they're raising the rate, or they rose the rate last week, and they're planning on raising it some more. So how are mortgage rates lower now than what they were? So kind of break that up. We have to understand interest rates, right? There's the mortgage interest rates, and then there's the rate that the Federal Reserve is raising. So the Federal Reserve is often referred to as the Fed. So when the Fed says we're raising rate, they actually don't raise mortgage interest rates. What they raise is what's called a federal funds rate, which is basically a rate at which one bank borrows from another. So it's an inter borrowing rate between banks. Has nothing to do with the mortgages and stuff. Now, mortgages are based on something else. They're based on what's called the mortgage bonds or mortgage-backed securities. Those affect mortgage interest rates. So how are they tied, right? So first of all, when the Fed says we're raising rates, and when they rose the rate for the federal funds rate, which is at which banks borrow between each other. What that affects directly are short-term debts like personal loans, business loans, credit cards, stuff like that. Those rates are going up when the Federal Reserve says we're raising rates. Federal mortgage-backed securities or mortgage bonds are based, again, on the bonds. So what the Fed says they're going to do can have an effect on the rate, on the mortgage interest rates or on the mortgage bond, but it doesn't always have to. So for example, when the Fed announced early in the year that they're raising the rate, that they're going to be doing the raising the rate 7 times this year, obviously a lot of investors, they panicked and they started selling off the mortgage bonds, right? So when people sell the mortgage bonds, or investors, when they sell the mortgage bond securities, what happens is it decreases in value. The mortgage bond goes down in value, which raises the mortgage rates, right? Now, counter effect, when people are buying the mortgage-backed security or mortgage bond, it's the mortgage bond goes up, the more people buy it, at which point mortgage rates come down. So at the beginning of the year, or the end of the first quarter of this year, when the Federal Reserve Bank announced they're raising the rate, then we had the whole Ukrainian war. We have the inflation numbers, the unemployment numbers, all these different economic markers started coming out, and investors naturally got spooked. So what they did is they started selling off all those mortgage bonds, okay? By selling those mortgage bonds, it devalued the bond, which means the rates just went up, okay? Now, fast forward to about a week ago. Again, Federal Reserve Bank says we're raising the rates, but investors have been very confident in the market, and they've been buying into the mortgage-backed securities, or mortgage bonds. So the mortgage bond went way up in value, which now caused the interest rates to come down. So it's kind of like a counter, even though the Fed just rose the rate, it didn't negatively affect the mortgage bonds. Bonds can be affected by, yes, the Fed, by policy, by foreign, like, events outside of the U.S. Like, could it be war? Could it be other global economies? Because anything that could spook an investor to buy or sell, that could affect mortgage bonds or mortgage interest rates. So Fed raising the rates not necessarily going to affect it negatively. It could just not even affect it at all, or it could have a positive effect. But so that's that. So when the Fed keeps talking about raising the rates, doesn't mean that your mortgage interest rates are going up necessarily. So yes, they can, but it doesn't have to be. It could stay linear, it could go down. It just depends. Matter of fact, today interest rates came down a little bit again. So when the beginning of the year started happening and all these economic markers, as I've said, started coming out, a lot of people spooked. Investors were spooked, and rates just went up. Well, mortgage bond securities just went down, which caused the rate to go up. And then it all kind of started going linear, and now it's rates are coming down because mortgage bonds are going back up because there's just more confidence in the market. So that's how the interest rates kind of work in a very simplistic terms. That's how the rates are operating. So don't necessarily pay too much attention to what the Fed is doing, what the media is telling you about the Fed, and how much they're trying to spook us about rate increases and stuff like that. Again, there is connection there, but they're not the same. They're not affected directly. So the next question is, what's happening in the market? What are the predictions for housing? Well, according to every analyst so far, or most of the analysts, is that housing prices will go up. They're projecting the real estate values to still go up by over the next 12 months, not as much as they were before, a lot less now. Instead of being double-digit growths, now they're going to go up by single-digit growths. Most estimates are between 5% to 9% that we're going to see that those real estate prices go up. Now, every market is a little different. So market in Florida and market in Pennsylvania might be a little bit different, or in Arkansas. So there might be some differences, and the growth might not be the same, but overall growth is still projected. Part reason why is because of the demand, right? So one of the reasons why mortgage real estate is still going up is because there's still such high demand. More people are looking to buy than there's houses available for sale. Demand is being pushed, or the supply demand curve is being set off by such different things like foreclosures are at an all-time low. Less than 3% of all mortgages in the United States are in foreclosure, which is a historic low. Part two is because when rates went all the way down in 2020 and 21, a lot of people refinanced and put themselves in a better situation with a lower payment, so they don't have to go out there and pay, sell their house to make ends meet, or they're not in as much trouble as they were, because values in real estate went up so much. Some people just took out money, paid off all their other debts, so they're in a much better financial situation now than what they were 2 years ago or 3 years ago even. So less people are now, inclined to sell their house or need to sell their house. And obviously with prices going up, some people are just less inclined to sell, causing that supply shortage compared to the demand. And then not to mention the whole fact about new built homes. So looking back several decades, let's say the last 4 or 5 decades, there's the amount of homes being built has been going down. Actually, the decade between 2010 to 2020 has seen the lowest amount of new homes being built, less than 5 million, compared to decades before, averaging between 15 to 20 million a decade. So that's a huge decrease in homes that were built over the last decade, which for many reasons that happened. One of them is the building costs, obviously now supply of shortages of supplies and stuff, costs of those supplies like lumber and stuff. So just overall, the new built homes have been declining steadily, and it's been an all-time low this past decades, causing more of that supply demand issues for available housing. And the other part is also income, right? So why are still so many people looking out there to buy when everything is so expensive? Real estate is expensive, and taxes have gone up, insurance have gone up. How are people still able to afford, even though rates have gone up too? Well, it's because also income levels for most people have gone up as well, especially those people that have recently graduated or that are in these new fields like IT and stuff. Income levels overall have gone up as well, despite what a lot of politicians like to tell you. If you look at income levels from 2010 to 2020, it's been constantly going up as well. So, not necessarily to keep in line with inflation, but overall it's been going up as well. So that's why there's still so many buyers out there, because they do have the disposable income to afford mortgages, and also because today there's so many more creative mortgage products out there for people that were self-employed at one point that couldn't qualify through a traditional loan through a bank. Now there's options for them as well, and we have them here at Countryside Home Loans. From bank statements to profit loss to stated income, we've got them, so we can offer those as well. So that's getting more and more buyers into the market again, in a market that's already challenged with supply. So just adding more to that supply demand issues, and so that's pretty much the prediction with real estate, and why prices are still holding strong and going up is ultimately because of that supply and demand issue. Now, when people ask, should I buy now or should I wait, or what's my opinion on it, and yeah, so it's definitely a good time to buy. I would definitely recommend it. Why rent? Why pay somebody else's mortgage? Why give somebody else all the tax benefits that you can have yourself by owning a home? All right, so that's all I have right now. If you have any questions, anything you want to know more specific, any particular mortgage questions or financial questions, feel free to reach out to us. We're always happy to talk to you guys and give you any information right now. Okay, thank you so much, and it's been a pleasure, and stay tuned for those updates.